Welcome to Wealth Building Through Real Estate, your weekly guide to understanding the dynamics of the housing market and uncovering investment opportunities. I'm Dusty, your host, here to break down the latest trends and insights in a calm and thoughtful manner. Let's dive into the world of real estate for the week ending May 24th, 2026. Kicking things off, financing conditions have seen some shifts. The benchmark 30-year fixed mortgage rate has risen slightly to 6.51%, marking its highest point since August 2025. This uptick comes amidst high inflation and geopolitical tensions. Despite this rise, rates are still below mid-May 2025 levels, offering buyers a modest window for affordability in a balanced market. On the supply side, active listings have shown steady growth. While asking prices are softening slightly, the inventory remains robust, nearing multi-year highs. New listings and the selling pace haven't changed much, which indicates a market heading towards equilibrium after years of shortages. It's a sign that supply and demand are finding their balance. Transaction activity tells an interesting story. Pending home sales in April showed resilience, climbing 1.4% from the previous month and up 3.2% from a year ago, with strong performances in the South, West, and Midwest. On a weekly scale, there's been a slight dip of 1.1% in sales, yet buyer demand persists, driven by a market still attracting interest despite rising rates. Let's talk home prices. The Redfin Home Price Index noted a 0.2% monthly increase in April and a 2.1% rise from last year. However, performance varies by region. Some areas like Montgomery County and Cleveland saw significant gains, while others, such as Oakland and Newark, experienced declines. It's a mosaic of growth and opportunity depending on where you look. Turning to the sector of residential REITs, there's been some retracement. Equity and U.S. REIT indices have dipped slightly, reflecting investor caution with rising rates. Yet the stability of private real estate, delivering solid income returns, shows that this sector continues to be a reliable wealth generator. Take the Armor Residential REIT as a case study. It's seen its share price pull back recently, but it offers a forward dividend yield of over 17%. This highlights the potential for high yields in specific real estate sectors, albeit with inherent price volatility. So, what does all this mean for long-term wealth building in real estate? Even with higher financing costs compared to pre-pandemic levels, they remain modest by historical standards. This stability invites yield-driven strategies and offers buyers a rare moment to secure competitive rates. The gradual normalization of supply conditions and steady transaction activity ensure momentum in the market. Regionally, places with strong job growth are seeing above-average price gains, presenting opportunities for targeted investment. Cities in the Midwest, for instance, continue to offer both appreciation potential and favorable cash flows. In summary, the data from this week paints a picture of a housing market positioned for measured growth, stabilized supply, and ongoing demand. It remains a fertile ground for those looking to build wealth through real estate and related securities. Thank you for joining me today on Wealth Building Through Real Estate. Remember, when the dust settles, only the truth remains. Until next time, stay informed and keep investing wisely.